Well, thank you, Jim and John. Now I have to give a paper. Oh, okay. This is work with Olivier Blanchard, who may be monitoring us from Paris. I'm not sure. And it's about inflation. And the question, what caused it, may be a little bit ambitious relative to what, but we do find some stuff that I think will be useful, at least in helping to understand the inflation. So here's some overview of what I'm going to do. As you know, there was very large fiscal action in the US during the COVID pandemic. At least at the headline level, total fiscal spending in the US during the pandemic was 4.5 times relative to GDP, the size of the post-GFC fiscal package, ARRA. This was enormous, really big. And when the American Rescue Plan was put out by President Biden shortly after his inauguration, another 1.9 trillion, there was a lot of debate among economists about whether or not this would be inflationary. So there were, as I say here, two views at the time. The inflation optimists said, well, okay, there may be some excess output gap here. There may be some tightening of the labor market, but we know the Phillips curve is flat. We know inflation expectations are well anchored, so we wouldn't expect to see very much inflation. That was a very common view, held, by the way, on Constitution Avenue. The inflation pessimists, which included my co-author, Olivier, and also, of course, Larry Summers and others, said, well, wait a minute, this is a huge fiscal impulse. We're not confident the Phillips curve will remain stable under these conditions. We're not confident expectations will remain constant. So we could get inflation. Now, it turns out that both sides were sort of right and sort of wrong, in that the pessimists were right that inflation, of course, came. In fact, it was more than they expected. But they were wrong, and the optimists were right in that the inflation did not come from an overheated labor market or an overheated economy, okay? It came instead from shocks to prices given wages. So, as you know, obvious ones include oil price shocks, food price shocks, and the like, and I'll be going into that. So essentially what we're going to show in a very simple model, I'm a little embarrassed how simple this is. In a very simple model, we're going to show that the most of the inflation, and most of it up till now, has been driven by product market shocks, not labor market shocks. However, product market shocks, we will show, are very transitory, while labor market shocks are much more persistent. And as a result, over time, the labor market shocks are becoming an increasing share of the remaining inflation, which suggests that getting this, eliminating the inflation, getting back down to target, is not going to be free. Okay, so we're going to look at a very simple traditional model. Tobin would like this model of wage price dynamics. It's an aggregative model. We're not going to be worrying about used car prices or anything like that. We're going to be looking at the economy as a whole. And it's going to have 4 equations: nominal wages, prices, and we rely a lot on expectations. We're going to have an equation for short-run inflation expectations and one for long-run inflation expectations. Okay, and we'll see that wages depend on the state of the labor market, on inflation expectations, which affect what wages people ask for, and what we call a catch-up effect. The idea that if inflation was higher than you thought, that you're going to try and push to catch up and get that back. Prices are going to depend on wages and other cost shocks, and expectations will depend on history and current inflation. Now, very simple model, but we will see that both in its pure form and when it's estimated, it actually can capture some fairly complicated dynamics, and I want to emphasize that as I get to it. So here's the model. Again, very simple. This is the wage equation. The first line here says that nominal wages depend on expected prices, plus something called the real aspiration wage. I'll talk about that in a minute. Plus something that depends on X is the tightness of the labor market. So it could be unemployment rate, it could be a variety of things, okay? So that's the wage equation. We're going to assume that the aspiration wage, which we want to think of as being the focal point for wage bargaining, and it's a real terms, or maybe the long-run equilibrium real wage in the labor market, we're going to assume that it adjusts gradually, where today's aspiration wage is alpha times last period's aspiration wage plus 1 minus alpha times last period's real wage plus stuff. Okay, now Again, this is by far the toughest math in the whole paper. Okay, now combining those two equations, you get this one. This is our wage equation. There's two cases I'd like to mention here. Suppose that alpha is 0. Alpha, remember, is the adjustment of aspiration wages. If alpha is equal to 0, then this says that nominal wage growth, think of these as log nominal wages, with nominal wage growth is equal to expected inflation, this term goes away, plus beta times the tightness of the labor market. In other words, elementary first year Phillips curve. Okay, if alpha is greater than 0, you get a little bit different result. You get, there's also a term here, which we call the catch-up term, which says that wages will also respond to previous mistakes about inflation. If you know, you're bargaining for your wage for 2022, and in 2021 gas prices went up a lot and reduce your standard of living, you know, you're going to press to get some of that back, and that's the catch-up term. This also, alpha being greater than 0, also has the property that that wages depend both on the level of tightness and also the difference of tightness to some extent. Okay, so that's the wage equation. That is the hard one. Easy one, prices are going to depend on wages. Of course, we're suppressing any constant terms, plus some shocks or indifferences. Inflation depends on wage growth plus changes in the shocks. Okay, now in our application, the cost shocks are the obvious ones, energy prices, food prices, and we're going to include the term to capture supply chain issues, sectoral shortages, and so on. Okay, now the expectations are going to play an important role here. Let me start with the bottom equation for long-run inflation expectations. So pi star here means long-run. It's not the central bank's target. It's an endogenous variable. It means long-run, but people think inflation is going to be 5 to 10 years from now. And we're going to assume that it adjusts adaptively to last period's long-run expectations, plus it's influenced by last period's inflation, actual inflation. And then short-run inflation expectations here depend with a parameter delta on long-run expectations. So there's a tendency for short-run expectations to gravitate towards long-run, plus also it responds to current or last period's inflation. Okay, so that's, again, simple adaptive expectations. A point I want to make, it'll come back, is that when you write down the whole model, 4-equation model, pi star is not determined. You can pick any level for pi star. And what it means in practice is that if you have a period of high inflation that drives up pi star, then you can find a new equilibrium with pi star higher. Okay, so there's no natural rate of inflation in this model. And in particular, the usual central bank concern about keeping inflation, long-run inflation expectations anchored matters in this model, because if you don't, you're going to have a permanent increase in the inflation rate. Okay, now this is, again, a very simple model, but it actually has kind of some interesting properties, even in this simple theoretical form. Okay, so here we're looking at how inflation responds to a one-time oil price shock. And this is just the impulse response function, the dynamic response. It turns out to depend on the parameters in an interesting way. What I call here weak feedback is the blue line, is what happens when there's no catch-up effect or very low catch-up effect, and inflation expectations are very well anchored. If those two things hold, then a shock to prices from an oil price shock, for example, is not going to be very persistent at all, and it's going to return quickly to the baseline. In contrast, strong feedback means that there's a powerful catch-up effect. I think of the 1970s and COLAs and wage contracts that, you know, that make up for losses in previous buying power, and inflation expectations are not very well anchored. That is, the parameters I showed you in the last slide are such that expectations respond fairly strongly to current inflation. In that case, a one-time inflation shock is going to have quite a persistent effect, and in fact, it'll have a permanent effect, because this is going to affect long-run inflation expectations, which will create a new equilibrium at a higher level of inflation. Likewise, the model has interesting implications for what happens if there's a tightening of the labor market, which is an increase in the X, remember, from the wage equation. Strong feedback is the case where inflation expectations are not well anchored and there's a catch-up term. In that case, you get a much stronger and more persistent response of inflation to a tight labor market, whereas if in the other case where there's no catch-up effect and inflation expectations are well anchored, you get a much smaller and equally persistent, actually, but less big effect. Okay, so we're going to estimate this model, and we want to think of it as an SVAR, a structural VAR. What that does, what we're going to do basically is it's very close. It's not strictly a structural VAR, but it's very close. What we're going to do essentially is we're going to use the model I just described as the contemporaneous relationship among these variables, and then we're essentially going to have unrestricted lags of all the variables in the equation. So that's going to allow for very free dynamics. Okay, so we're going to use quarterly data from 1990. We've played with it back to 1982 and using different data because some of this doesn't go back. But anyway, it doesn't change things very much. We're going to use the employment cost index for wages, the CPI. For prices, it doesn't matter if we use the PCE. We're using the Cleveland Fed's expectation series, which goes back to the early 80s, which is a constructed series, which includes both consumer expectations and market inflation expectations. So it's not truly a real-time measure. When we use instead the Survey Professional Forecaster real-time forecast, we get, again, very similar result. Now, an interesting question is how do we measure labor market tightness? That turns out to be, this is something that the Federal Reserve had a lot of trouble with in 2021, 2022. And let me show you why. This is what's called the Beveridge curve, which I'm sure you're all familiar with. On the y-axis is vacancies or job openings. On the x-axis is unemployed people or rates. These are in rates. Okay. And normally the Beveridge curve is downward sloping. The higher the unemployment rate, the fewer vacancies employers need to post in order to hire workers. But a very interesting thing is that during the pandemic, the two lines at the bottom are pre-pandemic Beveridge curves. This one is the within the pandemic is the Beveridge curve, and this is the latest number, so it is coming down a little bit. But there was a big shift up here, during the pandemic, and it's very interesting to talk about why that's the case. People had higher reservation wages, they didn't get called back to their old firm, there was a lot of reallocation. But I'm not going to get into that very much here, but simply point out again that there has been a very big shift, more so than other countries, interestingly enough. So the question is, what's the right measure of labor market tightness when you have this kind of shift? And what I want to argue is that just picking the unemployment rate, or U minus U star, is not such a good idea. So suppose your natural rate is 6%, just for sake of argument, and think of drawing a vertical line at 6%. Well, before the pandemic, that line would have intercepted here, okay, and would have implied vacancies like that. So that would have suggested a very, balanced labor market with vacancies and unemployment similar. But given the movement of the Beveridge curve, the same unemployment rate now reflects a much higher level of vacancies. So it seems to us that a situation where for a given number of people looking for work, there's a lot more job openings, that's a tighter labor market, even if the unemployment rate is held constant. And so that was very quick, but that is why basically we're going to use V over U. We're not religious about this. There are other measures one could use, like quit rates and so on. We've tried some of them. VU over U works pretty well for the United States, but it works about as well also in the pre-pandemic era as the unemployment rate, but that's what we're going to use as the measure of labor market tightness. So again, in the spirit of structural VARs, we're going to use a contemporaneous relations defined by the model. It's actually a recursive model. Wages depend on lagged variables. Prices depend on lagged wages. Prices depend on current wages. Inflation expectations depend on prices, and so sequentially, it's recursive. So in contemporaneous terms, the model is recursive, but then in each equation, we're going to allow sort of unrestricted dynamics, including 4 unrestricted lags of each independent variable and all endogenous and exogenous variables that appear in the equation. So this is going to have a lot of free dynamics when we estimate the effects. Okay, now there's one more thing to talk about before looking at the results, and I'm making really good progress here, so there's going to be plenty of time for questions, I think, which is the problem of shortages. So we all know that there was a lot of discussion of supply chains and other problems created by the pandemic. And here is an example. This is these data from Fred are about the automobile industry in the United States. And you can see that after recovering, after the lockdown was over, production recovered to pre-pandemic levels, but then it began to decline. Here at less than 9 million annual rate, it was almost a quarter, 25% less than the normal levels. So a substantial reduction in production, which we know was not from a decline in demand, because you can see here what happened to auto inventories. So here we are in the third quarter of 2021. Auto inventories are at rock bottom because people were trying to buy cars and there were no cars available. You all know the story, the semiconductors, et cetera. And what do you think that does to prices when there's a strong demand and no supply? Well, here's inflation, quarterly inflation in new vehicle prices, and you can see the big jump right around the same period. And of course, this generalized, and there were supply chain problems in many industries, and even industries where there was not unusual supply chain issues. There was the question of normal capacity. People came out of the pandemic with a lot of spending money from the fiscal policy and from savings over the pandemic, and there just wasn't enough supply to meet the demand in many sectors. So how are we going to measure that? Well, we tried various things. There's various indices. The New York Fed has an index, which we tried, and a variety of other things. The thing that worked for us was looking at Google Trends and counting the number of times that people searched for the word shortage. And there it is. There's blue line is chip shortage. The red line is car shortage. And you can see how it lines up very nicely. We found, by the way, this works for other countries too. Not staking, everything on this. There are other measures one could use, but this one seems to work pretty well. If anything, it works too well. And as you see that the shortage variable is, in fact, very influential.
Ben, can I ask?
Yes.
Can I bring you back actually 2 slides to the dynamics? I wanted to ask a slightly detailsy question. So the structural equations, some of them had lag terms in them.
Yes.
And then here you're saying you have unrestricted lags. Does that mean that you have the lags that are in the structural equations and then you add other lags, or is it only the diagonal terms in the VAR?
Let me show you. Let me show you the results. And so take a look at this equation here. Oops. This over here. Well, let me go back. I jumped ahead. I'm sorry. Okay, this is the wage equation. Okay, so wages depend on V over U. They depend on the catch-up term, and they depend on inflation 1-year expectations. And we also have a productivity term, a moving average productivity term, which I'm not going to talk about very much here. So those are the things that wages depend on in the model. But in the actual estimation, here are the lags that we use. We use 4 lags of the variable being, which is the dependent variable, growth in wages. We use 4 lags of V over U. We use 4 lags of the catch-up term. We use 4 lags of the 1-year expectation. So what we're doing is allowing essentially these contemporaneous relations to occur dynamically over time. So that's what we're doing. If a variable doesn't appear in an equation at all, it doesn't appear as a lag either. But if it appears in the equation, we allow 4 lags, and it adds a lot to the dynamics. So here's the wage equation. We have found, this might be a good time to mention that since we put out this paper, we have within weeks, we had a project going with 7 other central banks, all of whom are doing this for their own country. And the nice thing about the simplicity and the fact that we make all our programs available is that they can do it for their own country in like a week. And so we just had a call the other day where we compared our results to those of UK, ECB, Bank of Japan, et cetera, et cetera. Anyway, one of the things that we find is that the wage equation is the tricky one, is the hard one to fit. This is simply the fitted value. The red is simply the out of sample fitted value of the equation. So it's estimated up to before the pandemic. And then this is what the fitted value during the pandemic. The blue line is the actual, the red line is the fitted. It kind of gets the general trend right, but it misses some short run movements. And in particular, the biggest miss is right here, where the lockdown led to unemployment rates that were 14% or more. And so the model says, well, that ought to really kill wages. And that didn't really happen because there are presumably some constraints on, nominal wages falling, et cetera, et cetera. So this is not a perfect fit, but it's probably good enough for what we want to do. And the features here that I want to point out, 2 things. One is this is the relationship between nominal wage growth and V over U. And these are the P statistics for, this one is for the hypothesis that the sum of the lags is 0, and that's rejected. And this is for the hypothesis that each of the individual coefficients is equal to 0 jointly. It's joint hypothesis. That's also rejected. Won't go into details, but basically what we do find here is a pretty strong and pretty stable Phillips curve that wages respond pretty predictably to vacancy to unemployment ratios. Here's the catch-up term. Remember, if this is positive, that means that people are trying to get back their lost buying power. And we, both here and in other countries, we find it pretty much close to 0, that there's just not much evidence that people are being able to get back their lost buying power in subsequent wage negotiations. This is the price equation. Yes.
If you look at the 70s, the catch up is at slightly lower frequency than that. It takes a couple of years for wages to catch up. So is it possible that you just don't have enough lags here to capture the catch up?
Certainly worth trying. It's certainly worth trying. At some point, it becomes difficult to tell whether it's catch up or other factors that are moving it. Okay, this is the price equation. And I just want to point out a couple of things. One is that, as you would expect, the CPI responds very strongly and very statistically significantly to growth in the price of energy. So energy price shocks obviously move inflation around a lot. This, by the way, is going to capture not only the direct effects, but also secondary effects, on goods that rely on energy in one way or another. This is the food indicator. Again, powerful effects on inflation. And shortages, which is, again, this Google Trends thing, that some of the variables is not significant, but jointly, the hypothesis that each of them is 0 is easily rejected. So there are some lags at which shortages are very important, and we'll see in the simulations that they make a big difference. So this is the actual and simulated inflation for the pandemic period, and here we hit it pretty well. We capture not only the general trend, but also these are quarterly numbers, by the way, so that's why it looks so jagged. This is not annual 12-month numbers. Okay, so I'm not going to say much about this. One argument one could make would be that fiscal policy did not create inflation by giving people money to spend, but rather it contributed to a global boom in commodity prices. And that in turn was a source of inflation, as we see. And so what we did here to try and test that was look at 19 raw commodities that are in the CRB index, take the first principal component, that's the blue, and then compare it to the actual CPI energy and food indices. And the results are kind of mixed. I mean, the energy prices do seem to go along pretty well with that first principal component. Food does not. It's been a big puzzle why food prices have continued to rise, even though the raw materials that are used to make food have come down. So we don't draw strong conclusions here. I mean, the other possibility is that there are other things like general reopening, fiscal policy elsewhere, and so on that were contributing to this. So if you think we have not explained the commodity price boom, you are correct. These are the equations for inflation expectations, and the most interesting variables are, we show that generally they're quite well anchored, but the most interesting variables, this is for the long run inflation expectations. This says 1 percentage point of extra inflation in a given quarter only raises long run inflation expectations by 0.025 percentage points. So long run expectations seem to be very well anchored. Short run expectations are more responsive. A 1% increase in inflation during a quarter raises people's short run expectations, actually 1 year expectations, by 12 basis points. So that is more responsive. And there are the fits of long run and short run inflation expectations. Notice the axes are different. There's much more response, obviously, in the short run, very rationally. So that works pretty well. Now we have an empirical model,
And can I
and
ask one question about
Yes.
the fit? So you showed us a number of results for the COVID period, which is obviously where most of the action is in inflation. But if I understand correctly, you estimated the model back to 1990. Was the fit of the model stable in relation to over the sample period?
So it's a good question, and one we need to explore further. It's stable. If you ask the question statistically, can you reject that the extra period is the same coefficients as 1990 through 2019? Sometimes yes, sometimes no. But the thing that seems striking to us is that whether we use the when we use the pre-2020 coefficients, we fit out of sample the variables pretty well, and that seems that in terms of the economics that it's pretty close.
Yeah, I was thinking also about some anecdotes like the commodity price boom that occurred, right preceding the Great Recession in 2006. It would be kind of interesting to know whether the model, fits well the impact on inflation during that period as an example.
Yeah, so one of my first questions to Olivier when we were talking about this was, well, we had oil price booms, in previous periods, and we didn't get inflation. And the answer is right here, conveniently enough. So remember, in the theoretical model, if you have so-called weak feedback, which means not much catch up and very well anchored inflation expectations, then in shocks to prices tend to be very short-lived. Okay, and the only reason that oil prices, for example, were a big contributor to the recent inflation was because they kept rising and rising and rising. But one single shock the effects would diminish quickly. And so if you apply this model back to movements, for example, there was a big increase in oil prices, I recall very well, in 2008. It didn't last very long though, and so the effects on CPI diminished quickly, and that's all consistent with, these are the empirical impulse responses, and they correspond very closely to the weak feedback case. Because what we found, recall, was that there was not much catch up or any. And we also found pretty well anchored inflation expectations. So we wouldn't expect this hypothetical impulse. These are the impulse responses of the model to a shock to energy prices, food prices, or to shortage. And they're very transitory. So you need consistent ongoing oil price increases to have inflation from oil prices. And so it does in fact fit period that you're thinking of pretty well. And I should add, although I don't show it here, that we've gone back to 1982, but to do that, we had to use average hourly earnings instead of ECI, and that has other issues. Okay, so, and then the same exercise, we can look at the impulse response. So on the bottom there, this is the empirical impulse response of and note that I'm now using the full model. I'm now doing the general equilibrium, if you will. All the equations simultaneously are being solved, and all the lags are being taken into account, et cetera. So the model predicts that with a weak feedback, which is what we found, that the response of inflation to labor market tightness will still be persistent, but it won't be as strong. And the numbers, by coincidence, here are actually about exactly the same as they are here. So we get the theoretical implications show up, very nicely. And to summarize them, shocks to prices in product markets tend to be very transitory, both in the theoretical model under weak feedback and also in our empirical results, whereas shocks to labor markets tend to persist. How strong they are depends on the parameters, but they continue to persist as long as the labor market remains tight. Okay, now I'm coming to the punchline. Now, when you take this model, you can calculate impulse response functions. So you can take a shock to the oil price, and you can see how it works its way through the whole system, including all the lags, and how it affects inflation over the next however many periods, okay? And because everything is linear in this model, if you take the impulse response functions of every variable in every period, including the residuals to the equations, they all add up to actual inflation, okay? Now, what we did was we decided to ignore the residuals, so we throw those out, and we simply ask, how can we explain the actual inflation by adding up the impulse response functions to the things up here, the V over U, energy prices, food prices, and shortages. We don't deal with productivity. What we do is I should add that we take the data up through 2019 as given, and we simulate it forward using the model, and that gives us what we call the initial conditions. So that's what would have happened essentially if there had been no new shocks after 2019. So this gives us a decomposition of inflation, and we're getting very close to the punchline. So what we have here, the brown bars are the initial conditions. They show you what would have happened if, given what was going on in 2019, if there had been no additional shocks. And this sort of suggests that inflation would have kind of stayed around 2%, a little higher here because of tight labor markets. What else? The solid blue line here is the effect of energy prices, and you can see it's huge, and it's bigger in Europe, of course. So the energy prices have been a big driver of inflation, and here, of course, more recently, they've been a big driver of disinflation. By the way, the black line is the actual inflation rate quarterly, and the dashed line is the sum of the bars. So that comparison of the dashed line and the solid line tells you how well this model forecasts inflation, excluding the residuals in the equation. Food doesn't do much, that's the light blue. Shortages seems to do quite a bit. Here we are in 2021. Remember, I showed an earlier picture where inflation in 2021 was responding pretty strongly to supply chain issues, and that's what this shows. But shortages are still having an effect, apparently, on inflation going forward. And then finally, and this is, I think, an important takeaway, the red is the contribution of tight labor markets, V over U, to the inflation. Early on, it was actually a negative contribution, okay? That was basically the result of the lockdowns and the pandemic, et cetera, et cetera. Then after that, once things began to open up, it began to have a positive contribution, and it's a persistent one, but you can see it's still a relatively modest share of the total inflation. So it's increasing and persistent, but the story again is that inflation was not caused by overheating economies or overheating labor markets. It was caused by these shocks to prices. This is the same picture, but this shows the decomposition of wages, nominal wage growth. And here you can see the red is much more important. So tight labor markets have a much more bigger explanation for wage growth. But other things, including energy and shortages, are working as well. Again, I want to emphasize that there's many indirect connections here. So for example, why would energy prices affect wages? Well, if energy prices raise inflation, which raises inflation expectations, which makes wages higher, which makes prices higher. You know, there's a general equilibrium kind of relationship there. Okay, so that's those two pictures are really, I think, the main takeaways that again, that inflation initially was driven by shocks to prices given wages and not by overheated economy. The overheating has become more of an issue recently, and it will become, as the other factors die away, it will become the main source of above trend inflation. This is our projections. Don't take these with a big grain of salt. This looks in terms of V over U under 3 scenarios. The top scenario is it stays where it is, or 1.8. Second scenario is it's taken over 2 years down to 1.2. And the third scenario is it's taken over 2 years down to 0.8. And you can see that, you know, if you get it down to 0.8, that will get inflation back to target and below. But if you leave it where it is, inflation will be sticky. Yes.
What surprises me the most is the relatively small role for V over U, just because of the fact that there's been other work, like for example, by Larry Ball and colleagues at Brookings, or in the Brookings papers, which has emphasized the role of that variable. So I was just wondering if you could talk a little bit more about the relationship to the work that has emphasized.
To unemployment?
Yeah, to the vacancy over unemployment ratio. Why is that not more important is basically what I'm asking. I thought that there were other studies that had really.
Well, there's some technical differences with Ball. One of them is simply they stop their analysis like 8 months before we do. A second one is they assume they impose a very long lag for VU to affect wages, which means it takes a long time for reducing VU to affect wages and prices. But the last thing, the real economics here, which I want you to take away, is that if you want to translate these V over U numbers into unemployment, which is what we care about, it depends a lot on what happens to the Beveridge curve. If the Beveridge curve comes back to its pre-pandemic level, then some level of unemployment, not much higher than it was in 2019, will be enough to get inflation down. Whereas if it stays where it is, you know, you'll need another extra percentage point or so, something like that. So none of these things predict, you know, really, really high levels of unemployment, but the exact relationship does depend on the Beveridge curve. All right, I'm going to close here with conclusions. So simple, very simple model, but you got to take into account all the second round indirect effects, working through wage bargaining, expectations, and the like. Substantively, shocks to prices, not overheating economy or labor market tightness, set off the inflation. And those shocks are largely dissipating on their own, which is good news. And we're seeing that in the report yesterday. We're already seeing some of that happening. Although overheating in the labor market played a small role initially, it is set to become increasingly the primary driver of inflation over time if it stays where it is. So to get inflation down further, we're going to need some slowing in the labor market. Now, whether that means no increase in unemployment or a percentage point increase in unemployment, that is very hard to tell because that's going to depend on the Beveridge curve. If the Beveridge curve comes back to normal, then the unemployment consequences might be quite small. And I finally wanted to say that I mentioned this earlier, that we are doing this now as a joint project with a number of other central banks who've also run this model for their economies and gotten pretty intuitive results on the whole. Okay, I'm done. Thank you for your patience.